I'm Rick Kaler. Thanks for joining me. So the economic train is speeding faster and faster, and the edge of the financial cliff is getting closer and closer. The passengers are starting to scream. Meanwhile, the guys in the cab of the engine are arguing about whether to hit the brakes or blow the whistle. What's the best thing for investors to do? I would suggest it's nothing. Based on my emails this week from clients and readers of my column, there seems to be widespread concern amongst investors that we're on the verge of panic and the markets are about to head south. It reminds me of the good old days back in the fall of 2008 when the markets were dropping 900 points a day. I'm sensing that similar type fear amongst investors about going over the fiscal cliff. It's pretty interesting to me. The only difference is that today the markets aren't dropping. Those who assume that the markets are about to drop might be right. If that's the case, what should you be doing to your portfolio to prepare for this? Assuming, of course, it's globally diversified and in 5 or more asset classes, I would suggest nothing. Now, many investors are already sitting on the sidelines in bonds, shifting through a plethora of bad news and waiting for markets to tank. They have good reason for their expectations. There's been a steady stream of bad news over the past year. A feeble global economic recovery, the near certainty the U.S. will raise taxes and cut spending, which is the fiscal cliff, staggering budget deficits around the globe, the prospect of a Eurozone breakup, a highly negative and divisive political presidential election, banking scandals, and also a nationwide drought. Now, considering all that uncertainty, it's pretty easy to explain why investors have generally favored bonds over stocks over the past 12 months. With all this bad news, one would expect that stocks would be down significantly. For the 12-month period ending September 30th, 2012, 40 markets had positive returns, with 6 countries, including the U.S., delivering a total return in excess of 30%. And this is according to the investment analysis firm Morgan Stanley Capital International. While most investors think that successful investing requires constant attention to current events, research says quite the opposite. The more that investors pay attention to breaking news and adjust their portfolios, the lower their returns. But with the looming fiscal cliff, shouldn't a wise investor bail out now and then buy back in at the bottom? Well, that would be like jumping off the train before the crash and waiting until it has hit the ground, been repaired, and is back on the track before you get on again. The only problem is there's no way to know whether the markets will go down, or if they do go down, how to know when they're going to hit the bottom and it's time to get back in. That's the problem. So the worst action you could take right now is to sell out your portfolio and go to cash. If you have a globally diversified portfolio, the impact of the U.S. decision to tax more and spend less will have much less impact on you. For example, our typical 60-40 portfolio only has 13.5% in U.S. stocks and 25% in U.S. bonds. Over half of it is in international stocks, bonds, and non-U.S. correlated investment strategies. It's designed to cushion even extreme fluctuations in the markets. Anyone who is appropriately diversified has no need for fear as we get closer to plunging off the fiscal cliff. To protect your investments, don't sell out. To preserve your peace of mind, don't panic. Above all, don't jump. The best possible response is to simply stand by and watch the train wreck. Thanks for listening.